Thank you, everyone that has taken time today to join us in this webinar. This is TradeStation, of course. You probably are already aware of what we do in this session titled Options Replay. Our guest speaker is Brandon Wendell. He's a trader and an educator. He has a lot of trading experience, and we're very glad to have him today. But before I pass the microphone over to him, let's go through some introductions and some disclosures just to make sure that we have all the information handy. Just keep in mind that every symbol and idea that we talk about here is for educational purposes only, that these are not recommendations of TradeStation. Also, that active trading is not suitable for everyone, especially when it comes to trading options, which carry a higher degree of risk. Also, that any examples we present are just for that purpose as an example and not a recommendation. And there's no, of course, guarantee of future results. If anybody needs additional information on these disclosures, go to www.tradestation.com/important-information. And before we jump over to today's topic, I want to remind everyone that we have the Options Education Center available to everyone that visits tradestation.com. So once you're on our website, and if you hover over Learn, you'll find Options Education in there. If you like today's presentation, you just need to scroll down a little bit on this page, and you'll find this banner that's titled Options Replay. And if you want to see some of our prior presentations, just click on Watch Previous, and this will give you access to 3 presentations that we've done already as an options replay, so that you can also benefit from some of the education shared in those presentations. And just to let you know a little bit about Options Replay, this is just a place where we look at practical examples of option strategies, some of the events and things that are happening in the market that makes us decide, which strategy or option strategy to use and whether that strategy worked or not. So it's a great way for us to see trades in a practical setting. And Brandon does a great job at showing us, what are the things that we should think about, when trying to place one of these option strategies. So without any further ado, let me go ahead and stop my share and pass it over to Brandon. Brandon, it's great having you today.
Thank you for having me back. I appreciate it. Yeah, welcome everyone. Glad to see everybody here today. And I'll go ahead and share my desktop then. So let me get that going here. And I should be up and running with my TradeStation. And there it is. Hopefully you guys can see that. Yeah, it looks like it's good. So we are going to kind of pick up part 2 from where we left off. We were talking a bit about trading company events. And one of the main things that people kind of get involved in is earnings. Obviously, we have earnings coming out all the time. We just had some major earnings being released recently. They're always coming out on a regular basis every quarter. And in addition to that, there are special company events. The one I use as an example is Tesla. I mentioned that I had put in a simulated mode a couple of different opportunities on Tesla, and I was going to kind of dissect those with you. And remember, one of the things that I started covering as a review just a little bit, and the videos are available. You can review those as much as you like, or as little as you like. But no, basically, we talked a bit about volatility and the effect of volatility when it comes to choosing some of the strategies. And I basically broke it down kind of into 3 steps typically when it comes to the way I look at options trading. And again, this is just one viewpoint. There's many different viewpoints and ways of doing this. You got to find the style that works best for you. There's nothing that's foolproof out there. I do take losses. It happens. But one of the things I try to do is simplify as much as possible. And I kind of mentioned this before when I'm looking at perhaps some earnings coming up. Actually, this one's today, so that probably won't work. We have next earnings day, 10/28 at 4 o'clock. That's, about 2 minutes ago, right? And one of the things you'll notice on the screen is look at volatility. Now, I have a couple of indicators available here to us that are built right into TradeStation. And I'm going to get back to my first thought. I know I left something out there talking about how I view the options, but I'm going to get back to that. Here we have extremely high volatility right now. You can see on the implied volatility, all options, it's extremely high compared to the average, and implied volatility compared to historical volatility is also very, very high. The reason why? Well, as I mentioned right here, if I move the price out of the way a little bit, next earnings date is now. So we are at the peak of the unknown. And another way of looking at it, volatility is investor fear gauge. The more people are fearful of the unknown, the more they're going to demand for the risk they're taking in the markets. And that's going to typically drive option prices higher. So what I was saying earlier was when it comes to my options trading and a quick review, step one is you analyze the underlying security and you figure out which direction the underlying is going. Are you bullish? Are you bearish? Or are you neutral on the underlying security? And hang on, let me sec here. Actually, there's toggle drawing toolbar. I thought I had it on. There it is now. And I was going to take off the snap mode. There we are. So again, which way are we going to go? Now, when it comes to earnings or announcements, we don't necessarily know, right? So unless you're an insider trader, which is illegal, but we typically don't know whether the markets are going to respond positively or negatively. The example that I used was the October 11th, I believe it was 10th or 11th, the robo taxi or cyber taxi that was coming out and being announced by Tesla. And I was looking at a couple different ways of playing that. So if we don't know which direction, sometimes we have a bullish bias, sometimes we have a bearish bias based on trend, and sometimes the markets are neutral. And the beauty of options is we can play neutral markets. Playing the direction is something we deal with. And I also referenced the Greeks, which we'll visit again in a little more detail. But we have delta, and delta is options reaction or the option premium reaction to the underlying price movement. Oops, accidentally hit my caps lock there. Then we have Vega, which is the reaction to volatility. And another one is Theta, which is the time reaction or time value, time decay. Basically what happens to premiums on options based on time passing. So the nice thing is with options, we have multi-directions or multi-dimensions, if you will. We can trade the directional movement of a security. We can trade the volatility changes without the directional influence, and we can play time. Now, there are two other Greeks, and we'll get into those a little bit more as we go through the programs here. But number one, which direction is the underlying going? Okay, number two, we go back. And there we go. Number two, are options cheap or expensive? And I said that one way of kind of determining this is built into TradeStation. Actually, two ways, multiple ways, really. I shouldn't even limit it. There's a multitude of tools available with TradeStation to do this. One is what you're looking at right now, the implied volatility, historic volatility, or implied volatility of your options. And you'll typically see, as I put in a vertical line at the earnings releases, and this is actually a number that's showing after the earnings release. So the actual earnings release is typically a day or two before that. And just like you're going to see as we go forward, it's not going to show today. It'll actually show the earnings a couple days after. But going back, you can see that as we approach the earnings, volatility increased quite a bit. And you can see here, compared to the average, this blue on the bottom, or cyan, whatever you want to call it, that blue, let me thicken the line a little more. And that is the actual volatility, implied volatility versus the average implied volatility. You can see the closer you get to the earnings, the more you're getting to that unknown, the higher volatility is. And typically option premiums will become very, very overpriced, overvalued. So we have to take that into account. We don't want to buy expensive options unless they're likely to become more expensive. Right? I don't mind buying something if it's expensive, if I can sell it for more. But typically, if options are expensive, we usually look to sell them because the volatility, as you can see, decreases once the earnings are known. Once the unknown becomes known, there's less fear and the volatility drops. And that's a pattern that repeats itself over and over and over again. Here it is again. Another earnings release. Again, right there. That was the earnings release itself. The day after is where they published the number. You can see what happened to volatility. Prior to the release, volatility increased dramatically. And then afterwards, it dropped. And the nice thing is with options, we have the chance to play both directions. It doesn't matter, or no direction. And that was kind of the example that I was looking at when I started talking about Tesla. And again, I'll get to that one. Where's my pictures here? Open up my file that I have. I actually have it organized today, although, and my trade manager. So I'll bring those up and hopefully I can zoom in a little bit to see these. But yeah, here is one that I put on called a straddle. And the reason why, oh, no, that's AXON. Sorry, it's not Tesla. I had that mislabeled, didn't I? This is the one right here. Apologies. Here we are. And yeah, there we go. So the entry for both of the trades, what I did was actually an iron butterfly and an iron condor. And the reason why I did that, instead of a straddle, I just mentioned the straddle where you can buy an option and sell an option, and whichever direction prices go, you could potentially benefit. The risk profile for one, might as well show you what it looks like. Let's see, Option Station Pro, and I'll use Tesla. I may actually have a couple open already, but going to Tesla as it is right now, I'll just use these, it doesn't matter. Current price is 261. So let's say we do buy the 260, call and put, analyze. And there's our risk profile for a straddle. We're straddling the market because it doesn't matter which direction the market goes, up or down. We are looking to profit from either direction. So if prices go up, you can see it's an infinite potential profit. In reality, it's not infinite because you have the options expiring at a certain point. You can only move so far, so fast. But theoretically, your maximum risk is going to be the amount you paid for this option. And actually, I've got, nope, I had custom stuff in here. So let me try this again and delete the positions to clean it up. There we are. Now I have the straddle. So November 15th, 260, buying and selling. My max loss is the $2,700 it would cost me to get in. My max profit, it shows infinite, but in reality, it's not going to go that far. Okay. So basically, in this case, if I'm looking for the straddle, I can play either direction. The problem is I'm paying $2,500 to get into this, or $2,700 actually. Okay, so there's a cost that's involved with getting into this because I'm buying two options. So what I did with the Tesla was I decided to do what's called an iron butterfly. Actually, yeah, I did the iron butterfly instead of just a butterfly because I bought a call and bought a put. And I also sold a call and sold a put to reduce the cost. So whenever you reduce your cost, you're reducing the amount of risk. Whenever you reduce your amount of risk, you also reduce your profit. Okay. Those go hand in hand. You can't have more profit without more risk and vice versa. So the one strategy that I deployed is a little different than what I'm showing here. All I did was go back to, let's see, the options and added on a couple little wings, if you will. So let me go a little bit further in options here. So I did 260. Let's just do, yeah, I'll sell 250 put out of the money. And I'll sell a 270 call out of the money. And you see it became an iron butterfly. And what has changed when I go to the analyze now, make sure it doesn't have all of the pieces there. Yeah, let me get rid of the straddle. And there's the iron butterfly. What that does is you notice the wings have contracted, which means I don't have to have prices go as far to make a profit, but there's a flat line on top. I will only make a certain amount of money. I cannot make infinite profit anymore. Well, in reality, is the price going to go infinitely up or infinitely down? Well, obviously, Elon Musk would love it to go infinitely up, but it's not going to, right? Especially in the time frame that we have allowed for the options we're trading. So I did the iron butterfly as an opportunity to be able to trade whichever direction the news caused the price to move. It didn't matter. I was what we call delta neutral or close to that. My delta on this position, for instance, is 12. If you can get your delta between 10 and -10, you're considered roughly delta neutral. I mean, absolutely neutral would be zero. That's almost impossible to attain for a good strategy because prices move and it shifts. You have to be dynamic with it as well. You might have to make some adjustments in this position. So in this case, this was a debit. And the reason why is because I have a max loss of $2,700, and it's the debit that I'm paying for that position. That's the straddle. But when you go to the condor, or sorry, butterfly, there we are, iron butterfly. Now look what my price is, $875. But notice what's changed. Okay, now I'm not saying this is a good position. I just threw it in as an example. I've reduced my risk from 2,700 to 875, right? So I reduced it quite a bit, and I've capped my max profit. Before it was infinite, now it's 125 bucks. So I probably wouldn't want to risk 875 to make 125, obviously. So this one was a debit, okay, not a credit. This is a debit. Now, the other alternative, which I did as well, was an iron condor, and that was actually a credit spread, I believe. Yeah, and you can see right here too. Filled price 1290. That means I paid 1290. This shows parentheses filled price 260. That means I was paid 260 for that specific trade. So I received a credit on that one, but I paid on the other. Okay. So that goes back to the basics of my trading. Are options cheap or expensive? If they're cheap, I would lean more towards a debit strategy. If they're expensive, I would lean more towards the credit strategy. And that way I'm selling something that's expensive or I'm buying something that's cheap. And actually, there's a great question that came up. Don Damon was saying, okay, so for this strategy, should the volume be in section 3? Well, going back to the straddles for earnings, I think it is, on this workspace, one of the tools that was created right there, you have IV range percent RS. That is basically an indicator that Jesus helped create for us and is part of this platform. You can see that when we're looking for some of these strategies, and just turn that one on. There we go. Perfect. And right now it's saying less than 40. What this indicator is doing, and I don't know if we have a visual of it. I think we only created the one for the radar screen. That's what RS stands for, is radar screen. But if we go into studies, add study, I'm pretty sure that we only did the one part. And we could add it, but it's not really necessary for the visual right now. And let's see. Apply, oh, range percent CH. Maybe we did do it on the chart. I forgot. It's been so long since Jesus and I put this together. There it is. And yeah, so right now, and you could change this around with the coding a little bit too, the easy language if you choose to. But what this does, and I kind of mentioned it before, this indicator in the center, let me disable the other one for now so we can focus on one only. Okay, there we are. IV range percent CH. CH is for chart. RS, again, is for a radar screen. What this is doing is taking the last 52 weeks or last year of implied volatility, the last year of historic volatility, and creating a range between the 52-week high and 52-week low. And it's dividing it into 20 percentiles. So you have 20, 40, 60, 80, and 100%. Well, if the options, or I should say the implied volatility, come on. If in this indicator, which is the IV range percent, if you are below 20%, that is cheap, really cheap. Now you got to keep in mind something that's really cheap can become even cheaper. Okay, it's not at 0. 20 can go down to 10. But typically, if implied volatility is extremely low, it's more likely to go up than it is to go down. Again, it could go down as well. But you notice, for instance, on the CDNS, if I go back before earnings, look at this. About a month before earnings are released, look where implied volatility is. That is implied volatility plotted against the 52-week high and 52-week low in a percentage. Okay, so it's not the actual implied volatility number on it, but it's a percentage. And you can see this was pretty low. It's probably somewhere in the neighborhood of 10 to 20%. Actually, there we can probably see, come on, instead of focusing on price, there you go, 20%, 40%, 60, 80. So anything between 0 and 20% is in section 1, which means options are very, very cheap, really cheap, put it that way. Again, doesn't mean that they can't get cheaper, because they can. You'd like to buy cheap, right? If it's between 20 and 40, so still less than 40%, it's relatively cheap. And you still probably want to be on the debit side. That means buying options or doing debit spreads. If it's in between 40 to 60, or actually, yeah, between 40 and 60, it's kind of evenly priced. And I can't spell. There we go. You're kind of evenly priced and kind of in the middle, so you can kind of take your pick. You want to go ahead and price them out and look. And this was the other thing I mentioned. There's different ways of figuring out if options are cheap or expensive. This is one of them, looking at implied volatility. It's not the only way. Another way of doing that is on OptionStation Pro, going back to the options themselves, and you can use the little wrench right there, customize the columns, and bring in something called theoretical value. So you have this theoretical value for the option. Well, right now, the theoretical value for the 260 call is $17.56, but it's trading between 15.25 and 15.50. What does that mean? If you can buy this at 15.50, but it's really valued at 17.50, you're getting a $2 discount. That's a huge discount on a $15 stock or option, $15 option, right? Would you want to sell this at $15 when it's valued at $2 higher? Of course not. So implied volatility might be low right now in Tesla, and we'll look, okay? However, the puts, again, $12 to $12.20. Meanwhile, the theoretical value is $14.49. So these options are currently trading well under the value. It's not really a surprise because the earnings were just recently released on Tesla, weren't they? So if I were to go back, and I'll come back to my other chart in a moment, but if I go back and instead of CDNS, we go to Tesla, look at the implied volatility right now. It was very high, and well, it doesn't show next earnings date, but I know we just had earnings numbers come out a couple days ago, I believe, wasn't it? So you can see the big gap where it was, and what's volatility doing since then? It's gone back down. So options are relatively undervalued versus overvalued on that CDNS just before earnings. Hopefully this is making sense. So if we were to look at CDNS, again, where is my text? There we are. If we get to 60%, actually, sorry, it's under 80%. Now we're starting to get overvalued options. And we may want to start looking at credit spreads. Now, could they get more value, a more increase in value? Absolutely, they can go higher. There's nothing saying they can't. But the probability is if you're overvalued, you're likely to come back down towards the mean. Now, I said this before, most securities in the markets are mean reverting. They go back to their average. That's why it's an average. The averages change. They go higher or lower, but we usually revert back to average prices and average values. So if you have just less than, basically, it would be 80%, or I should say greater than 80%. That's in section 5. I forgot to put all the sections in here. Relatively cheap. Section 2, evenly priced. Section 3. And then, of course, section 4 is the overvalued options. And finally, very expensive. And that's section 5. So you typically want to buy when volatility is low, and you typically want to sell when volatility is high. Why? Because regardless of the direction, when the volatility changes, Vega is typically one of the greatest impacts on the value of options compared to all the other Greeks combined. So even though if you had done, say, a bullish strategy right here, but you bought options and the prices went up, let's say you bought calls here, when that volatility dropped, you're losing on Vega, and it could be almost as much as you're gaining on the Delta, if not more, plus time decay. So in this case, you might have been better off selling puts with high value because those puts would drop in value, especially because prices are going up and you're going down in volatility. So the option becomes cheaper that you sold initially, and you're profiting from the direction going against you. It's going further out of the money. So everything's working in your favor at that point, and time is decaying as well. So that would also be a factor of what kind of option you choose as far as time. We'll dive more into those in a little bit. But basically what I did, and again, let me go back over, these are the filled entry orders. There's an iron butterfly, and I placed these just before the news came out. These are actually, it says 24, 10, 18. So they were very short-term options just before the news came out and just before the expiration. They only had 9 days left until expiration. Debit, that's not necessarily a good strategy. I'll put it bluntly. Typically, when I look at buying options, you want to remove some of the risk that you have involved in those options. And one of those risks is time value. And if you're not aware, the time value on options decays much quicker. It's exponential. It's not linear. So the closer you get to expiration, the faster they decay. You could see that in an options chain. Again, going back to just single options here on Tesla. And let me get rid of order here. There we go. Get rid of the lines here. You can see that theta, time decay. There's 40 cents of time decay every day when there's 17 days left till expiration. Heck, 3 days left. Look at that. 81 cents of time decay. Well, actually 80 cents. We'll use the 260s. 80 cents on $7.85 of premium. That's a lot of time decay, right? And look at this. Again, 17 days, 260 at 40. So you cut your time value or time decay in half. Typically, if I'm buying options, I want those options to have an expiration where I'll still have enough. Well, I should say, I will still have 30 days left till expiration after the event. So again, if I'm planning for earnings coming up, remember we have the workspaces here. Let's look at an example. Straddles for earnings. And this is just an example. I'm not saying that we want to get into this in particular. I'm only doing kind of just basic analysis. So right here, Dollar Tree, for instance, DLTR. Oops, if I can click on the right one. It looks like it's got 30 days until the next earnings date, right? So right now, implied volatility, if we take a look, you can see this is a very depressed stock. It's been dropping down quite a bit. And when I look at our indicator, well, we're a little bit higher than I like to be. I'd rather be below 40 so that the options are relatively inexpensive. So maybe I don't choose this one. We can move on. I could also, again, go into the edit studies. I think I just disabled the others, didn't I? Yep. And we can even see in comparison to our average, we're above. And why are these on top of each other? That's weird. I got to fix that. But anyway, we're very high in volatility right now. Okay, well, that doesn't mean we couldn't play this one, but we probably want to sell options on Dollar Tree because, again, if I go to Option Station Pro, DLTR, remember, we have 30 days left till expiration, but now we're looking at expensive options, and we typically want to sell or do a credit spread on expensive options. So if I wanted to do that, we have 30 days left till until the earnings number, and I still want at least 30 days after that, so my time decay doesn't expire if I'm buying. But if I'm selling, I want the time decay. Remember, that's going to drop the value. So we're kind of flipping the scales here. Anytime I'm going long, let me go back to just some text here. There we go. Debit. We're basically buying options. You buy time. And on average, I want usually at least 60 days minimum, maybe even 90 if you can get away with it. Remember, the further you go out in time, the more you're going to be paying for options because you're paying for that time. But I kind of equated it to the bottles. Remember, if you were my age or older, you used to get bottles of soda and you could take the bottles back for deposit. You get the deposit returned to you in cash. Same thing here. If I buy an option, I am going to buy more time, but as long as there's not a huge erosion of that time value, when I sell the option, I should get a lot of that time value back. So I typically, when it comes to events, I buy options that will still have at least 30 days. Oops, forgot the space there. 30 days to expiration after the event. Okay, so I want to make sure that I still have 30 days left after the event, so I'm not losing a lot of time value. Now, if we're doing credit, we are selling, okay, sell less time. And if I can get away with it, 30 days or less. That's where you're going to be experiencing the most decay in the value of the option. So again, if we have Dollar Tree coming up, I don't know which direction Dollar Tree is going to go, but I could possibly sell options because they are typically overpriced right now. Not a whole lot though, compared to historical value. Again, I have too many indicators on top of this. Let me delete or disable that top one there. And you can see that that indicator is showing you we're only in about 40, what does it show? Oops. There we go, 46.48. So that's kind of middle of the road, isn't it? You still might be able to buy, but overall, we're still a little above average for our volatility. And if we look at the options on Dollar Tree right now, if I'm looking to sell, I do 30 days or less. Let's say the at the money option is 66. The theoretical value is $2.60. And that is not the normal spread, I hope. Because if I want to sell it, I sell it for 284. Even that, I mean, I could sell it for 284. That's above what the value is, isn't it? 620. I mean, this is a big spread. That happens after hours. The spreads widen. Okay. That's probably not going to be the spread during regular hours. I mean, it could, but I doubt it unless it's a thinly traded option. But even this, just looking at the sell price, even the put you could sell for 235 right now, retail price, and it's valued at 209. So what does that tell me? We could sell it for more than the theoretical value happens to be. Is that a good thing? Yeah, it should be. I mean, it's not guaranteed, of course. Well, I didn't really care for that one particularly, again, because, well, I actually shouldn't say I don't care for it. We can play that. What we would have to do is the other strategy, perhaps the iron condor. Now, you notice with the iron butterfly I did on Tesla, I did them both at the same time. Okay, and I'll show you the outcomes to them as well, because I do have those as well. Let me see where to go. Is that the picture? Come on. Oh, there it is. This was on 10/15. This was after the news was released. And you can see in this case, iron butterfly was profitable, wasn't it? The iron condor was not. Okay. And again, it comes back to what was happening prior to the news and those earnings. Let me go back to Tesla. It wasn't earnings, sorry. It was the news announcement. It works the same way. Earnings or news announcement, it works the exact same way when it comes to these things. Anything that's going to likely cause a big move in that particular security that is unknown We don't know whether it's going to be positively reacted or negatively reacted. You could do something similar to this. Okay. Would I sell weekly options 7 days or less if there's not much credit? Yeah, it depends on the type of return I'm looking to get. So I actually day trade a lot of the iron condors, believe it or not, on the SPX. And that's something we'll talk about as well. That's an event that happens every day. Every day, the SPX closes at 4 p.m. and you have PM settled options. And there's actually in the education series, where is it here? Options, education. There's sections on both. Actually, Jesus just put it out there, iron condors and iron butterflies. There's education on that that's available. And also kind of combining that, index options right there. So I look to do day trading, if you will, on index options. And there's some benefits in doing that and using this type of strategy for it, because the event that you're trading on is just the end of the day. But the same kind of strategies can apply to that. So here we are on Tesla. Remember, the date of the trade entry was the 9th. So let me put in a vertical line on the 9th. Or not. Where's that? 9th. There we are. I did have it. Okay. And what was going on with volatility? It actually was pretty high, wasn't it? And you can see that with high volatility, you would have expected that we want to sell rather than buy. And this is actually an exception to the rule, if you will. So where was this? Again, 10.9. Because what happened was, comparing the two strategies, you could see that this was on the 15th, the picture I took. Yeah, let's see, where's the 15th? Wow, I hit it right. Exactly, 15th. Notice what happened with the volatility. It went from section, is that 4? Roughly at about, yeah, 82.43. Oh, that's section 5. That's the upper section right there. And it dropped into the middle, just under 60, between 40 and 60. And we had above average volatility. It went a little bit higher, but eventually, after those earnings, it came back down. So what happened in this case? In this particular case, price was able to move far enough and fast enough that it overcame that decay of time and the decay of volatility. So that's what I'm saying. It's not 100% that anytime volatility is high, you automatically sell. I said you lean towards the debit strategies, you lean towards selling, but it doesn't mean you absolutely have to. One of the things you want to do is look back in history and see what type of price movement do you usually expect, and you can actually price that out. If I were to go back to Option Station Pro, and again, we have what, Dollar Tree, was that the one that's earnings coming up? It was, wasn't it? Let me go ahead and minimize this chart. So I'm jumping around here. Yeah, Dollar Tree, 30 days left until expiration. IV range, though, that's a little high. Let's go see what's lower. Hormel Foods. That looks pretty good. Oh, I actually closed. Let me see, what day did I close? No, I closed it later. I think I closed it right on the 17th, I believe. That's 10:15. Where's 17? I was late exiting. There it is. This was the day I exited. And actually, the profit on the long was $442 for the iron butterfly. The loss for the iron condor was 260. So it was net gain. I actually played both ways, kind of covered both directions, because again, the volatility was high, but in this case, the price movement was far enough and fast enough. Going back to the chart before I leave Tesla. '17th, and they expired the day after on the 18th. So I would have had the total expiration and loss, max loss on the iron condor, just because I didn't have a wide enough iron condor, possibly. And that was actually the error that I had in that particular position. It wasn't the fact that I had sold with the wrong volatility, because I did sell with high volatility. The issue was I didn't do a wide enough spread when it came to choosing the strike prices. And in this case, what was it? 230 and 260. I'm sorry, 235 and 260 were the sold ones. And you can see on the 17th, we were trading way beyond 235. We were trading around 220. So what should have happened, or what I should have done, and probably will do in the future as we go over this a little more, is take a look back to see, okay, on the last earnings, how much of a price jump did we have? So for instance, looking here, you can see we had a price jump prior to earnings closing at about 246, jumping to 224. Now, volatility was very high, right? And it went down. That's the pattern. Patterns repeat themselves in the markets. So if you see what the average price movement is and you can sell outside that range and still get enough premium to make it worthwhile for taking the position, you're basically playing the volatility and time collapse. So for my example I'm mentioning right now, or was about to mention, again, looking around, we got 30 days left until an expiration. Implied volatility, we want something low, Hormel Foods. Now, again, I'm not doing all the necessary analysis. So I'm not saying this is something I would trade, but just taking a look right now, this is probably not a good scenario either. We do have implied volatility above average. Even though we're 30 days away from the earnings, right? And you can see, what does it normally do? Before earnings, volatility rises. After earnings, collapses. Again, rises, collapses. But where are we right now compared to average volatility? We're above. The best place to do a debit strategy would be when we're below that 40% and below the average. Well, we're not there. So we'll look for something else that is. But I'll just stick with this one because this doesn't quite meet the characteristics, and I'm not going to give any kind of recommendations or just steer you into anything because I'm not allowed to. Okay. I'm not licensed. I don't do that. I'm just giving you education here. But theoretically, if I wanted to play this and we're in a relatively low environment when it comes to volatility, I'd be leaning more towards the long side. And now I have a choice. When I go to Hormel Foods, we're at about $30. Again, I could take a look to see. The one mistake I made in that Tesla trade is not looking back to see what is the average price movement when earnings come out. Well, in the past, we had a price move from close about 33 bucks, opened at 29.85. So we dropped about $3.50, so maybe a little under that. Looking back again, you can always tell where the earnings are. You hit those big drops in volatility, right? And again, you can see that we were right around 34, dropping down, and eventually, well, this was the day after earnings, price moved down to about 30. So we're looking at about $3 or $4 on average of price movement. The previous one, $31 up to 33. Okay, so that was a little lower. So let's say we're anticipating maybe a move of about, I'll say $3 to $4. We'll split the difference. We'll say $3.50. Nice and easy. Right now, we'll call it 31 bucks. We're trading at $30.94. Relatively low volatility, although that bothers me a little bit. You can also look at that other indicator as I was showing you for the implied volatility versus historic. So if we go to Hormel Foods on OptionStation Pro, is it HML? No, I forgot what the symbol was. HRL. HRL. The next big thing is, how do we place this trade in TradeStation and how do we protect it? And that's something I wanted to focus on as well. Well, if we're doing debit, I'll show an example of both debit and credit. If we're doing debit, first of all, we have 30 days left until the earnings. We want to make sure we have enough time after the earnings. So perhaps I choose the 80 days left until expiration. They will cost more, but remember, it's like a time deposit. I get a lot of that money back when I close the position. Now, for an iron condor, if I'm selling, I'm sorry, no, we were doing low volatility. We're going to buy. If I'm doing the butterfly or iron butterfly, I prefer the iron butterfly, honestly. It's personal preference. You could price them all out. With the iron butterfly, we're going to do what's called a reverse iron butterfly or a long iron butterfly. We're going to buy a straddle. So I'll buy the two strikes at the money and sell out of the money options. You could do it all at once like this by clicking. I prefer to build it leg by leg to kind of pick exactly what I want. So we're in between strikes. We got 30 and 33. I'll do the 30s. I hold down the control key and click on the ask price for the call and the put. Starts to build it. And then, let's see, we're probably not going to move more than $3 or $4. I could do 33, probably want to do 35. I'll do a $5 spread on the top and bottom, see what we get. So I'll sell this, wrong one. Sorry, I want to sell the call above. Put is below. There we go. So we have 30. I'm going to sell the 25. And I'm going to sell the 35. Wait, why did that not go? 25, click. There it is. And see, it says Iron Butterfly. And now I can go over to Analyze and see what this looks like. If the earnings come out and we get roughly a $3 move to either side, I should profit. And I could figure out exactly, we have 30 days left until those earnings come out, right? So I'm probably going to get out of this. And I go to graph. By the way, let me just kind of show you the steps that I'm doing here. I know when that news is coming out. I'm not going to be using the yellow. The yellow is at expiration. I'm not holding on that long because I'll lose all my time value. Okay, we're doing a debit strategy, so we want the time value back. What I can do, though, is figure out with these curved lines, or even change the yellow line if you see that one best, by using the little cogwheel here and changing this graph to show the day of earnings. Okay, we have, let's see, this is 80 days till expiration. So that means we would actually have, oh, it's already there, 40 days left. No, 50 days left. 30 days from now, 80 days till expiration. That means there's going to be 50 days left. So that blue, let's do the two lines. That blue line represents my Iron Butterfly at the earnings release, right? So what happens also is that we have to get out of this sooner rather than later when those earnings come out. Sometimes if the volatility keeps rising, watch what'll happen. This is kind of cool. Remember, this is at the earnings release, the blue. That's the one I really want to focus on. For me to make a profit, by the way, I can move these price slices until I can see what my break-even prices are on the upside and downside. There we go, upside, close to zero. Downside, get as close as I can. It's not going to be exact. Oh, I guess I can. There it goes. So those are my break-even prices on either side at the earnings day. So I only need prices to go up from where they are right now, about $2.65, or down roughly about the same. And if it does that, I'll start to profit on this position. The other thing that will also happen is volatility is going to go up. And that's one thing I didn't check to see. Let's go back and see right here. We're currently right around this 27 and 25. So let's see. The last time we were at this price before earnings, you can see what happened. It went from roughly 25 right before earnings were released. We were at 40. So that's a 15% increase in volatility. What would that do to our options price? Right now, you see the theoretical value is 0 and 0 based on the current implied volatility. If we were to go up, let's say 5%. Going to go? Yeah, there we go. I'm going to change the plot to plot 2. And what does that do? It's plotting it based on the blue line now instead of the yellow line. If plot 2, just the volatility goes up by 5%, you can see if we get to what used to be my break-even point, now we make 41 bucks. Or if it goes down to my break-even point, now we actually make $13. My break-even point moved closer. That's why volatility is important. If it goes up by 10%, look at that, $51. By the way, this whole thing is only costing me $265 to get in. Even if I profited $51, that's a good rate of return of what, 20% roughly? I don't know, terrible at math. You think it'd be better at math when I do options, right? No, calculator, there we go. So 51, 30, divided by, how do I need to go? 51.30 divided by, what did I say it was 265 to buy this spread? 19%. Yeah, it was pretty close, almost 20%. That's pretty good off the top of my head. Okay. The starting point, basically what I was doing was I was adjusting right here under graph. Use the little cogwheel on the right and graph, and you can use price slices to figure out what your break-even prices would be on the earnings day rather than the expiration day. Because most people just look at the expiration day. I'm not holding it till then. I'm holding it till after the event or the day of the event. And what I'm looking at is right here. It says 50 days. If you recall, when I chose these options, I chose options that expire 80 days from now, but the earnings are 30 days from now. That means there'll be 50 days left till expiration when the earnings are released. And I do that because my theta, look at my time decay. It's a penny. It's a pittance. I'm not giving up a lot of time decay while I'm waiting for this trade to happen and for the earnings to come out. So again, if we get our average of 15% gain, now I make $61 at what used to be my break even if prices go nowhere. Well, actually, that wasn't last. Sorry. Let me go last. If prices don't move from where they are right now, I'll still make $32 on the earnings day. That's before earnings are released. What are the odds that prices go absolutely nowhere? It could happen. Absolutely, it could. But looking at history, the stock really doesn't move too much, does it, before earnings? It's after earnings it moves. So again, I could profit in one of two ways, depending on if I've made enough of a profit before the earnings are released because volatility increased, I could simply exit the position. And if I'm looking to make 20%, the other thing we can also do when we place our orders, bring up trade here. So right here, first of all, I know that I'm willing to risk a max loss right now of 265. That's what I'm paying. I can only make 235. In reality, I'm not going to make that much. Okay, based on the price movement, and I can even do that with the price slices. Again, going back, get rid of the ticket again. I can figure out, okay, from where we are right now, $30, if it does end up moving up, let's say $3, so 31 up to 34, there we are. Or if it goes down by $3, 31 down to 29, no, that's 2, isn't it? 28. Even if we get our average move, but volatility increases by that average of 15%, I'll either make $32 or $91. And I can get out on the day of earnings before the earnings are even released. If we don't move anywhere, I could still potentially profit from the volatility increase of 32 bucks. Well, again, $32, technically 32.76 divided by the it was a 265 to get in. That's a 12% return in 30 days for doing what? Nothing, waiting for the earnings. Now, to protect myself, if I know I'm likely to make a roughly $32 with the volatility increase, let me go back to 0 for the volatility. I could set up a stop loss if prices move too far. So that way I start losing, if I start losing a certain amount. Technically, I wouldn't necessarily do it on this because I go from, where are we now? Negative 34. Maybe if it goes down to negative 44. Oh, actually, sorry, let me put this back. Last. And yeah, I'll keep it where it is on that day. Sorry. If we remember, I'm looking to make roughly $32 if prices do not move, just playing the volatility move. I could risk $10 on either side. Let's see, where is it? Negative 10. And I could set up stops that if prices move down, can't really do it on the upside. But here on the downside, because if it moves up, I'm actually profiting. But right here, I could put in a stop loss that if prices move down to Oh, sorry, it should be 44 negative because right now I'm making a profit of 32 bucks, I think it was. So if I lose about $10, that means we're at $30.54. I could place a stop loss to get out if that were to occur to protect myself. And the way you would do that is right here. Oh, the max loss on the chart? Well, basically, whatever you pay for this, when you do a debit, the max loss is what you paid for the option. So when I'm under the analyze trade right here, it shows you max loss. And that is what I paid for the option. So that would occur on the chart if at expiration, the prices are at the $30 strike that we're selling. Oh, sorry, the $30 strike that we're buying in this case. Yeah, it's a debit. Yeah, it's a debit. Now, on the other side, I'll have to do this relatively quick because we're almost out of time. But before I do, again, if I'm placing this trade, I can also do activation rule. I know that if this goes against me by, let's say if it gets down to $30.50, I want out. I can get out by doing that activation rule. Or if it goes up enough that I make a profit of at least $35. That's at 32.34. Okay. Watch this. I go to activation rule. If HRL add goes greater than or equal to 32.50, or if it goes less than or equal to 30.50, and this would is something I would actually get into the trade first. Then I would put in the opposite trade right here and analyze opposite trade. Actually, let me put in this one without the activation first, just to show you. I can't route right now because it's after hours and it's not set up right at that. Anyway, but once I'm in, what I would do is do the exact same trade. Actually, I could show you on another one. I go to manage. There we are. And do I have a condor somewhere? I forget what all these are. Straddle, strangles. Oh, wait, I have another condor right there. Never mind. So I would just go to analyze close. Nope. Yes, it is. There it is. Iron condor. AEO. Trade. Change this from limit to market and activation rule. And again, I'll just pretend I'm using the other one, HRL, as my stock, HRL. And this, by the way, is activation rules. There's a video on this as well in the options education. But basically what I can do once I'm in the position, if the stock moved up and I made my profit of 32, it would be about a $32 profit at 32.50. That's what we analyzed. Or if prices were to drop down to my stop level price, it will automatically put in a market order to exit me. And that's it. I just let that go with the activation rule, the market order. And now I've got protection for both my profit. If we move up enough, I don't have to even wait until the announcement comes out. Obviously, if I wait, I might be able to profit more. Or if it goes down and I lose too much, I also can get out. So that's nice to be able to have that feature to protect yourself using the activation rule to exit. Can you add a strategy? Not that I'm aware of right now. Unfortunately, you just have the activation rule for that on the options. So you can't do it, I don't think, using the charts and the strategies right now. That would be great, but as far as I don't know anybody that can set that up for options to do it. There may be a way, actually, if you were to chart, I take that back. If you were to chart, and I don't know if it'll place the order or not. Typically, yes, you can put in the symbol for the option and place the strategy there. So yes, you might be able to do that. And I'll look into that for you.
Only
That's
on
an
single
interesting
options, though.
only on single option legs, right? Sorry.
Yes.
Okay. So yes, you could do it with just one option. You couldn't do it for a spread. But if you did the options individually, yes, you could place the symbol for the option itself, not the stock, in that options box right there, the symbol box. And yes, you could apply a strategy to it for a market exit. Yeah. So I'm glad I thought about that. And thank you, Jesus, for backing me up on that one. So yeah, unfortunately, I'm kind of out of time. I'm going to have to go ahead and continue this a little bit more next week, or next session, I should say.
Mhm.
And I'll just take a little bit more time in the next session to do the credit side, and then we'll move on to our next topic as well.
Yep. Well, as Brandon said, yeah, we ran out of time. We wish we could stay here a little bit longer. I am going to launch a small poll about the webinar, content-wise, and I would appreciate if you take a minute or two to provide us your feedback. And again, it'll take us a few days to get this presentation processed and approved by compliance before we post it on the archive page. I've made the link available right there in the chat window for anybody that wants to replay this webinar. Brandon, thank you so much for your time.
Yeah, real quick question to answer down. It's going to vary directionally on this one. You'll notice my delta is going to be very, very small because I'm playing both directions. So typically when I'm doing the butterflies or condors, I'm not really going to be looking for delta at all. I want to keep it kind of delta neutral. I'm playing more of the volatility rise or fall. Again, if I create the opposite order, or it was, I'm sorry, analyze. Well, yeah, right there. I only had a delta of 1.48. Directionally, if I'm playing direction, I definitely want to have some deltas, so probably 0.25 or more. But for this type of strategy, I want to have a very small delta of 0.01, if you will, or 1.48 for this full strategy.
Great stuff. Make sure you guys join us again in a couple weeks. We're going to do options replay one more time. Brandon is a recurring guest in TradeStation webinars, so just look out, for the events schedule and see when he's on. Brandon, again, thank you for your time.
Thank
Everyone,
you.
have a wonderful afternoon. I'll see you next time. Goodbye.